You've probably seen the videos promising to turn your 100 bucks into 10 grand overnight. Let me be brutally honest right up front, in a way most finance channels just won't be. You can't do that. Not safely, not reliably, and certainly not without gambling money you probably can't afford to lose. But here is what almost nobody tells you. $100 is not too small to matter. It is actually the most important $100 you are ever going to invest simply because of what it teaches you and what it sets into motion. In this explainer, we're going to look at the real, boring, almost unfairly simple math of how small amounts of money genuinely grow into serious wealth. There's no hype here, we're not flipping sneakers, and there's no secret side hustle that made me rich. We're just going to look at the exact mathematical system the wealthy have quietly used for a century. And the best part? You can start it today for the price of a dinner out. Let's dive right into section 1, the trap, and exactly why fast cash is a myth. We have to clear something up right away because it's literally costing people real money. Every single time you see a promise to turn $100 into $10,000 fast, it's always one of three things. It's a scam, a total gamble, or someone trying to sell you their course. The reality is, the actual stock market has historically returned somewhere around 7 to 10% per year, on average. And notice I said per year, not per week, not per month, per year. And yeah, some years it even goes down. Anyone promising you a massive 100x return in a flash is asking you to take on huge risk, usually in something they don't even fully understand themselves. That isn't investing. That's betting against the house. And the house, whether it's a scammer or a casino, wins way more often than you do. All right, section 2, the engine, compound interest. So, if the fast track is fake, what is the real one? The answer is almost disappointingly simple, and honestly, that's exactly why it works. Most people just lack the patience for it. You've heard the phrase compound interest, but let's talk about what it actually feels like. It's like a giant snowball rolling downhill. When you invest money, it earns a return. The next year, you earn a return not just on your original money, but on those returns too. Your gains start making their own gains, and then those make gains. In year 1, it's pretty invisible. By year 5, it's mildly interesting. But by year 20, it's doing more work than you are. And by year 30, the growth completely dwarfs everything you ever put in. Let's put some concrete numbers to this. Say you invest a single $100 right now and literally never add another cent. If we assume a roughly 8% average annual return, in 30 years, that $100 becomes around $1,000. That is 10 times your money from one single deposit, doing absolutely nothing but waiting. But here is where it gets really serious. Almost nobody invests just once. The real magic unlocks when you do it consistently. Moving on to section 3, the honest math of $100 a month. Let's say instead of $100 just once, you put in $100 every single month. That's a little over $3 a day, basically the cost of a daily coffee. Assuming that same historical average 8% return, let's watch how these numbers evolve. After 10 years, you've put in $12,000 of your own money, but you'd have roughly $18,000. That extra $6,000, that's the market working for you. Fast forward to 20 years. You've contributed $24,000, but your balance is around $59,000. Notice what's happening here. You only doubled your contributions, but your total balance more than tripled. By year 30, you've put in $36,000, and you're sitting on roughly $150,000. Your own money is now just a tiny slice of the pie. The rest is pure compounding. And after 40 years, that same $100 a month becomes somewhere around $350,000 from $3 a day. That's the part nobody believes the first time they hear it. You didn't need a huge salary. You didn't need to pick the next big tech stock. You just needed time, consistency, and the patience to leave the money alone. Now, I know exactly what some of you are thinking right now. You're saying, well, I don't have 40 years to wait around. Or maybe, honestly, $100 a month is a lot for me right now. Stick with me here, because this next concept is the absolute most important thing in this entire explainer. It proves exactly why starting right now with whatever you have completely beats waiting until you have a chunk of quote-unquote real money. Section 4, time is the fuel and why starting small wins. Most people have this idea that they'll start investing once they hit a certain income, so they wait. And waiting is quite literally the most expensive financial mistake you can make. Since compounding is powered by time, the dollars you invest in your 20s are worth drastically more than the dollars you invest in your 40s. They're the exact same dollars, but they have more fuel. Picture two people. Both decide to invest $100 a month at an 8% return. The early starter begins at age 25, invests for just 10 years until they're 35, and then completely stops. They never add another cent, just let it sit. The late starter begins at age 35, but they invest every single month until they're 65. That's 30 straight years of contributions. The first person put in money for 10 years. The second person put in money for 30 years. So the second person ends up with way more, right? No way. The early starter ends up with roughly the same amount or even more by retirement. 10 years of an early start can absolutely beat 30 years of a late one. It is wild, but it's not a typo. That is just compounding at work. So the lesson isn't that you need to invest more money, it's that you need to start right now.
All right, Section 5, the blueprint. Where to actually put the money.
So the math checks out, and starting early is the ultimate hack. But where does the money actually go? It doesn't go into a hot stock tip from your buddy, and it definitely doesn't go into whatever cryptocurrency is trending on social media today. For the vast majority of us, the most effective answer is boring, calm, and incredibly well-tested. We're talking about low-cost, broadly diversified index funds. In plain English, an index fund is just a basket that holds a tiny slice of hundreds or even thousands of companies all at once. When you buy a total market index fund, you aren't trying to pick the single winning company. You're just buying a piece of the entire economy. Think about it like this. When you buy a single stock, you're betting everything on one boat. If that boat sinks, your money sinks with it. An index fund does the exact opposite. If one company fails within that massive basket, it barely even registers. You are diversified by design. And historically, the broad market has always trended upward over the long run, pushing straight through recessions, crashes, and recoveries. Now, there are two absolutely crucial rules here. Watch your fees and maximize diversification. You want a low expense ratio. Many good index funds charge just a tiny fraction of a percent. A 1% fee might sound like nothing, but over a few decades, it will quietly siphon tens of thousands of dollars out of your pocket. And second, go broad. You don't need to memorize stock tickers, you just need to embrace the principle. Buy broad, keep it cheap, and hold it for a really long time. Section 6. The weak link. What ruins your investments? So what actually destroys all this beautiful math? It isn't the market, it's you. More specifically, it's your panic. Look, the market goes down sometimes. Not might go down, it will go down. There will absolutely be years where your account drops 20, 30, or even 40%. And in those terrifying red moments, every human instinct in your body is going to scream at you to sell everything and just save whatever is left. But the investors who lose are always the ones who sell during the panic. The ones who win are the ones who keep buying while the market is essentially on sale, or at the very least, they do absolutely nothing and just wait it out. Historically speaking, every single market crash has eventually been followed by a recovery to brand new highs. The drops feel permanent in the moment, but they almost never are. And this brings us to your ultimate defense, automation. If you set up an automatic transfer that invests your $100 every single month, regardless of what the news is saying, you completely remove the weak link. You remove your emotions. The system automatically buys when the market is high, it buys when it's low, it averages out perfectly over time, and it requires zero bravery from you. You just let the machine do the work. Section 7, the playbook. Putting it all together. Let's consolidate all of this into a straightforward playbook you can act on today. Number 1, forget the quick riches. That's a fantasy sold to people who usually end up poorer. Real wealth is built slowly. Number 2, compound interest is your engine and time is your fuel. The earlier you start, the less of your own money you actually have to save. Number 3, just $100 a month invested consistently in a broad index fund realistically scales into 6 figures over your working life. No hype, just the honest math. Number 4, start right now. Even if you only have $20 a month, building the habit is so much more important than the dollar amount. And number 5, automate the whole shebang. Protect your future from your own current panic and let time do all the heavy lifting. Which brings us to our final part, Section 8, your next move. We've covered the math, the mindset, and the mechanics. Here is your single, low-friction move right after this explainer ends. Don't overcomplicate it. Don't try to optimize everything at once. Just set up one automatic investment today. Choose whatever amount you can comfortably afford, even if it feels laughably small right now. The goal today isn't to get rich. The goal is just to start pushing the snowball down the hill. Once it's rolling, time takes care of the rest. If this explainer gave you a clearer, more honest picture of how money actually grows, then we did our job. Make sure to subscribe so the next explainer finds its way to you. And hey, let me know in the comments below, what is the one thing stopping you from starting right now? Drop it down there. I genuinely read every single one. Personal finance. No hype. Just the real math. We'll see you in the next one.